Hello again and welcome to the second episode in our accounting series. If you've not watched the first video of the series, be sure to click the link in the info card above to get to that video. Once again, this is a multi-part accounting series that's going to cover the essential curriculum for College Accounting 1 as well as test prep for UIL and BPA. So this series is intended to time to release videos throughout the school year to help you excel in your classes and competitive exams. Now, let's get started with Unit 2, Transaction Analysis. So the first topic we're going to discuss in this video is recognizing business transactions. So a transaction is an event that has a measurable financial impact on a business. Essentially, we're recording an exchange between two parties or more. For example, consumer goods for cash or a loan on credit. We're recording both sides of a transaction, and you might be asking, how do we do that when we're dealing with non-cash items? And so this is where we get to the analysis part of this. So here we're using the accounting equation A equals L plus E, assets equals liability plus equity, to record each side of the transaction. And within assets, liabilities, and equity, there are individual accounts that represent certain amounts a business has on hand. So with assets, the main things you want to know is it encompasses cash, accounts receivable, notes receivable, inventory, prepaid expenses. And so to describe this a little bit further, accounts receivable are essentially promises for future cash or future goods that you're expected to receive. So think about like services like a food delivery or a haircut. When the payment is actually made, this gets converted into cash, which is another transaction. And speaking of cash, cash is essentially just pure money that's on hand. Like you have it with you, it's in a bank or through physical cash, checks, CDs, etc. And so the next thing we're going to discuss is the notes receivable. Now, notes receivable is amounts that businesses are contractually obligated to pay, usually through a loan that they owe between businesses, right? And the next thing is inventory. Inventory is goods that are on hand that a company sells. So think about like merchandise that they're selling at a retail store. And the last thing for assets is prepaid expenses. Prepaid expenses aren't listed under the expense category because they're actually expenses that are paid in advance, like insurance or rent.
So the next thing is with liabilities. These are debts or payables, things that need to be paid off or payable. Accounts like these include, accounts payable. These are promises to pay a debt. For example, if you're purchasing land on credit, you get the cash up front, pay it off with the land, and you have to pay it back. So that's considered as an account payable. Notes payable is pretty similar, and these are signed notes promising to pay in the future. They're known as promissory notes, like bonds or loans. And accrued liabilities, these are liabilities for an expense that you have not yet paid. They're pretty similar to payables, but they're more used with internal things like salaries, interest, and taxes. For example, income tax is considered as an accrued liability. And for equity, these are the stockholders' claims to the company's assets. And like we mentioned earlier, it comprises paid-in capital and retained earnings, which is income minus dividends. And remember, retained earnings carry over from the year before, and that will be considered as a beginning balance in the financial statement for that accounting period. The way you can remember how to calculate retained earnings is with the acronym RED. Revenue minus expenses minus dividends. Remember that retained earnings and dividends are considered separate accounts because dividends are not considered as an expense when doing income calculation. Alright, so the double entry system and balancing the books is what you may think when you see the word accounting. Accounting reports the dual effects of each transaction. In an exchange, at least two accounts are affected. So these are T accounts, also known as a ledger. They're done for each specific account, for example, cash or accounts receivable, and records increases and decreases in a specific account. And they're divided into two sides, debits and credits.
Alright, and so great acronym to help you guys remember this that I've used and Rohan has used to help learn this material is the acronym DC-AILER. And so what this means is the DC stands for the debits and the credits, right, which is the initial division, right? And then you have aid on the side of D, right, it's on the side of debits. And you have LER on the side of the credits, right? So DC, aid, LER. So you kind of want to think about it into three parts. You have DC, you have aid, and you have LER. And so under the debit side, you have aid, which stands for, the A stands for assets, the D stands for draws, and the E stands for expenses. And then the LER stands for liabilities, equity, and revenue. Now, what's kind of neat about this trick and this acronym is that it really helps you visualize the relations between all of these different things. You can kind of almost think, especially from a beginner standpoint, that these are almost kind of opposites, right? Assets is really the opposite of liabilities, because assets you have something that's an economic benefit to you, but liabilities you owe something to someone else. Draws is essentially the opposite of equity, and this equity is also sometimes known as shareholders' equity or owner's equity. So if you see the term OE or E, it's the same thing, it's equity. And expenses is obviously the opposite of revenue. So it really helps you visualize those differences as well.
Notice how the behavior for each side of liabilities and equity is the opposite of assets. You can see that out here. An increase in liabilities and equity will be on the credit side versus an increase in assets is on the debit side. This is because the accounting equation has to balance, as well as the debits and credits for the entire thing. All the lefts and all the rights have to be balanced as well.
Yeah, and a very important thing to note is that everything on this is always positive. You're only gonna have, you can't have negative 200 of an asset. That's probably just gonna end up in the liability category or a different category. You're gonna have to figure that out. You're gonna have to make a change there because everything is always positive. You can only have 200, if you have 200 cash, it's gonna be in the assets category. If you owe 200, it's not negative 200 in the asset, it's 200 in the liability category, probably in the accounts payable. So that's something that's very important to know. So now with that information, let's move on to a couple examples to help you out. So now one main thing to note with all of this is that anytime you're dealing with T accounts, you actually have to record a transaction on both sides, debit and credit. So you'll see what I mean once we get to the examples. So for example, when you're buying a car for $5,000, so first thing you're gonna think, right, is that you're paying $5,000. So that's gonna be under liabilities, right? Because it's an accounts payable, right? You owe $5,000 to someone in credit, right? But you have to record a second transaction on this debit side as well. And so what we're gonna do to accomplish that is record $5,000 in debit under the asset portion. And the reason for that is because a truck is an asset, right? By purchasing that truck, you're adding some sort of economic benefit to your business, right? That truck,
All right, the second example is issuing stocks for $10,000. Let's say you're issuing stocks so that more shareholders are going to buy parts of your business and for growth purposes, right? So on the debit side, we're going to add 10,000 in assets, and on the equity side, you're adding 10,000 in credit for common stock. You see how we're putting equal amounts in debit and credit so that the accounting equation stays true and the debits and credits are balanced. The third example is a utility expense on account for $500. So since it's on account, we're going to consider that as an accounts payable or AP, and it's a liability, so we put $500 on the credit side. And the expenses, that would be a debit, since that's basically the opposite of what equity is trying to achieve. So we're putting in equity as an expense, and we're debiting $500. So like I said before, expenses do the opposite of revenues, and like dividends do the opposite of retained earnings, where we're looking at the equity accounts. These are known as contra accounts, where an increase in these accounts, like expenses, leads to an overall decrease in the account. So the T account rules are opposite of a regular equity account. An increase is a debit and a decrease is a credit. That's why expenses is listed on the debit side, even though it's considered as equity.
Yay!
Bars.
Wait, bro, I need to find a video editor. So now that you guys know a little bit more about T accounts and the different types of account types, such as assets, draws, expenses, liabilities, equity, revenue, let's actually apply this into some real life accounting scenarios. So the first thing we're going to talk about is journal entries, as you can see down here. And so a journal entry is just simply a chronological record of transactions. And it's going to be specified by that account type. Remember, the AID and the LUR, part of that DC-AID-LUR acronym. And it's also going to specify whether it's increase or decrease and how much it has. And it's also going to include sometimes an optional description for clarity. And so we're going to give you guys a few examples to show how it looks like in the journal and the T account.
So we're going to start off with the first example. We're going to start with $50K cash, and we're going to issue common stock for that amount. So here, since we're adding $50K in cash, since that's considered an asset, and for common stock, we're also increasing common stock, which is an equity. Notice how we're increasing both, and thus the accounting equation is balanced. So the way we're going to journal it is cash, we're increasing by $50,000, that would be debit, and common stock are increasing by 50,000, that would be credit. For the second example, we're purchasing supplies of $4,000 on account. So whenever we see on account, this is a good tip for anyone who's seeing this kind of thing in problems. This is not cash. We're not using cash, we're going to use accounts payable. So that's what you see right here. Supplies, we're going to increase by 4,000 because that's considered inventory, which is an asset. And accounts payable is credited, also increased by 4,000 since that's a liability. So asset is debited and liability is credited. The third example, we're performing services for 3,000 and we're not getting cash directly, rather it's going to be through accounts receivable. I thought I'd do that right here. So accounts receivable, that's considered an asset, so that's going to be debited or increased by 3,000. And since we're receiving the services, that would count as sales revenue, which is credited by 3,000 since that is equity or revenue. The fourth example, we're going to pay cash expense, which is rent, salary, and utilities. We're going to put those all together, and those would be considered as an expense. And we're paying it off with cash. So cash declines, and just a forewarning, we are always going to put debits first and then credits. That is just standard. So since expenses they're on the debit side, since they're added on, we're going to put it as debit, and we're going to individualize these because these are separate transactions. And then since we have to equalize it, we're going to have it as a decrease in cash. And so now cash is being credited, which means it's going down. That's what you see over here. When an account goes down in the assets portion, that's going to be a credit. So the fifth one is we're going to pay off $1,900 cash on the account payable. So let's say we had an account payable that was like probably up here. We're going to pay a part of it off with cash. So since we have credited it before, now we're going to debit it. Basically, we're decreasing the value of the account payable, and we're also decreasing the amount of cash. So cash is decreasing, so assets decrease, and liabilities decrease, therefore making the accounting equation balanced. Now the last example, we're going to declare and pay a $3,100 dividend. So remember, dividends, that's going to be an equity, and we usually pay that off in cash, because that's considered separate from the income. So dividends, we are debiting $3,100, because that's considered as an expense for a call for equity account, and cash again is credited $3,100 because that decreases. So remember, dividends is part of retained earnings, so retained earnings decrease, which means equity decreases, and cash uses an asset decreases, again balancing it. So now you see the debit and the credit side are balanced, and with every single transaction the accounting equation is balanced as well.
Yeah, and then a great thing to notice here is that we are actually going to indent every time you have a credit, right? So as you can see here, we had 3 debit transactions listed. So we didn't actually indent the second item. It's not just about it being the second item here, but it's rather we want to indent that first credit so that we can help differentiate between that debit and credit. Mm-hmm. And another thing is you're not going to actually number things on the journal entry. We just did that for simplicity's sake for you all to learn. What you're actually going to do is put the date here. So just FYI there. So moving on, the next thing we're going to discuss is the trial balance. So now, simply put, a trial balance lists out all of the accounts with their cumulative balances. After all the transactions are added up, a single number appears in either the debit or credit section, depending on the account. So the trial balance's purpose is essentially just to show that the debits equal the credits, which obviously we've emphasized is a very important concept in accounting. And it helps prepare the final financial statement at the end of the period, right? So the key difference between a trial balance and a balance sheet is that the accounts in the balance sheet are organized by the account type. And the key purpose is to show that the accounting equation holds true, whereas, like we said, with the trial balance, it's mainly just to show that the debits is equaling the credits. We don't really care as much for the actual account types.
So when we're looking at accounting analysis, this is really cool. Whenever you have like some kind of missing transactions here, you can effectively compute it when you're given the beginning and the ending balance and any other transaction that you get. For example, if the beginning balance is $1,200 and you have a cash receipt of $2,000, but your ending balance is $600, that's a disparity. So you know there's going to be a missing transaction over here in the credit section. So the cash payments, what is $1,200 plus $2,000? That's $3,200. So $3,200 minus $600. That means in the credit section, there's going to be a cash payment of $2,600. This process can be used to compute total cash payments, sales cash collections, or amount paid on account, because those are often missing payments when you are given additional information. So you can see down here in the trial balance, cash is entered at 600, and usually the accounts are listed by order. So assets will come first, and then liabilities and equity. And like he said before, the purpose is only to show that the debits equal to credits. So on the bottom line, you'll see debits equal credits. Now, in regards to accounting errors, the simplest type are when the debit and credit doesn't match up. Well, when it doesn't match up, you know that something's gone wrong. These are mostly computational in nature. We'll go over other types of discrepancies in future videos. So, for these, we compute the difference between the debits and the credits, and here there are a few possibilities for error. So maybe a debit account was instead recorded as a credit. For example, a $200 debit was recorded as a credit. So in that example, if a $200 debit was recorded as a credit, that means the debit accounts are $200 less than it should be, and the credit accounts are $200 more than it should be, for a total difference of $400. So in this case, what we would do is we would divide that out of balance amount by 2. So that's $400. We would divide that by 2 and you get 200, which makes sense as that aligns with the missing payment. Another possibility is a slide or transposition error. For example, $45 is recorded as $450 or $405, like the place values are a bit messed up. In this case, we're going to divide the out of balance amount by 9 to get rid of this.
That's it for our second lesson of this accounting series. So in the next few episodes, you're going to dive into more of the types of accounts, ways to manipulate them, as well as getting a basic understanding of dealing with accounts in the bank as well as financial holdings. You'll also learn how to perform similar types of entries in the corresponding accounts for the scenarios you're given. So thanks for watching and stay tuned for the next video.